Pure or static risks. The second category of risk is known as pure or static risk. Pure static risk is a situation in which there are only the possibilities of loss or no loss, as opposed to loss or profit. With speculative risk, the only outcome of pure risks are adverse in a loss or neutral with no loss, never beneficial. Examples of pure risks include premature death, occupational disability, catastrophic medical expenses, and damage to property due to fire, lightning, or flood. It is important to distinguish between pure and speculative risks for three reasons. First, through the use of commercial, personal, and liability insurance policies. Insurance companies in the private sector generally insure only pure risks. Speculative risks are not considered insurable, with some exceptions. Second, the law of large numbers can be applied more easily to pure risks than to speculative risks. The law of large numbers is important in insurance because it enables insurers to predict loss figures in advance. It is generally more difficult to apply the law of large numbers to speculative risks in order to predict future losses. One of the exceptions is the speculative risk of gambling, where casinos can apply the law of large numbers in a very efficient manner. Finally, society as a whole may benefit from a speculative risk, even though a loss occurs, but it is harmed if a pure risk is present and a loss occurs. For instance, a computer manufacturer's competitors develop a new technology, produce faster computers, processes more cheaply. As a result, it forces the computer manufacturer into bankruptcy. Despite the bankruptcy, society as a whole benefits since the competitors' pure risks such as an earthquake occur. Other risks besides insurabilities, there are other classification of risks. Few of them are discussed below. Fundamental risks and particular risks. Fundamental risks affect the entire economy or large number of people or groups within the economy. Examples of fundamental risks are high inflation, unemployment, war, and natural disasters such as earthquakes, hurricanes, tornado, and floods. Particular risks are risks that affect only individuals and not the entire community. Examples of particular risks are burglary, theft, auto accident, dwelling fires. With particular risks, only individuals experience losses and the rest of the community are left unaffected. The distinction between a fundamental and a particular risk is important since government assistance may be necessary in order to ensure fundamental risk. Social insurance, government insurance programs, and government guarantees and subsidies are used to meet certain fundamental risks in our country. For example, the risk of unemployment is generally not insurable by private insurance companies but can be insured publicly by federal or state agencies. In addition, flood insurance is only available through and are subsidized by the federal government. Subjective risk. Subjective risk is defined as uncertainty based on a person's mental condition or state of mind. For example, assume that an individual is drinking heavily in a bar and attempts to drive home after the bar closes. The driver may be uncertain whether he or she will arrive home safely without being arrested by the police for drunken driving. This mental uncertainty is called subjective risks.